Welcome to True Finance, where your financial future begins with clarity and confidence.
Welcome to our in-depth exploration of Theta, the Greek symbol representing time decay in options trading. This series will guide you through understanding Theta, its impact on your options portfolio, and how to use it to your advantage. Theta measures the rate at which an option's value decreases as it approaches expiration. It's the daily price tick that reduces the option's value, reflecting the diminishing time for the option to end in the money. Why is Theta crucial? For option sellers, it represents potential profit as the option loses value over time. For buyers, it's a challenge to overcome as time is literally money slipping away each day. The market doesn't move in their favor. Theta isn't constant. It accelerates as expiration nears, especially for at-the-money options. This means the option's time value decreases more rapidly in the final days before expiration, a critical concept for both buyers and sellers to understand. The impact of Theta varies with the intrinsic and extrinsic value of an option. Deep in the money or out of the money options have less extrinsic value, hence lower Theta. At the money options, packed with extrinsic value, feel the highest impact of Theta decay. Selling options, Theta selling, can be a lucrative strategy if managed correctly. Sellers capitalize on the inevitable decay, collecting premiums as the clock ticks down. It requires a thorough understanding of market movement and risk management to avoid potential losses from significant price movements. For buyers, mitigating Theta's impact involves strategic timing and selection of expiration dates. Longer-dated options have lower Theta, providing more time for the trade to work out, but at a higher upfront cost due to their greater extrinsic value. In portfolio management, understanding and managing Theta across various positions is key to optimizing returns. Balancing Theta-heavy positions with those having lower time decay rates can help in managing the overall risk and potential profitability of the portfolio. Advanced traders monitor the collective Theta of their portfolio to ensure that the overall time decay is aligned with their market outlook and trading strategy. This involves regular adjustments to counteract unwanted exposure to rapid time decay. Theta's impact is not uniform across all options. It's influenced by factors such as volatility, underlying asset price movements, and time to expiration. A nuanced understanding of these dynamics allows traders to anticipate and react to changes in Theta more effectively. For example, volatility spikes can inflate an option's premium, temporarily reducing the impact of Theta. However, as market conditions stabilize, Theta's effect intensifies, accelerating premium decay. One advanced strategy involves the calendar spread, which capitalizes on the differential in Theta decay between short-term and longer-term options. Traders sell near-term options to benefit from rapid time decay while holding longer-dated options to maintain a market position. Iron condors represent another strategic application, involving the sale of options combinations to create a position that profits from time decay, ideally under low volatility conditions. The key to success lies in managing the wings of the condor to mitigate risk while maximizing Theta decay. Effective risk management in Theta-centric strategies requires vigilant monitoring and readiness to adjust. This might involve rolling out positions to future expirations or closing out parts of a strategy to capture premium or reduce exposure. Moreover, integrating Theta with other Greeks, especially Delta and Vega, provides a more holistic view of your options exposure. This multidimensional approach enables traders to fine-tune their strategies in alignment with their market outlook and risk tolerance. At the portfolio level, balancing Theta involves not just selecting individual positions, but also considering how they interact. A portfolio with a balanced Theta profile can provide steady income through premium decay while minimizing the risk of large, unexpected losses. Advanced traders might employ software tools and quantitative models to simulate and manage the Theta decay of their portfolio under various market scenarios. This proactive approach enables more precise adjustments and optimization of returns. Despite its potential, trading strategies focused on Theta decay are not without challenges. Market shifts, unexpected volatility, and other external factors can disrupt the expected rate of time decay, necessitating quick and informed decision-making. Theta's influence is multifaceted, affected by the interplay of market volatility, interest rates, and the underlying asset's price movement. A deep dive into these relationships reveals how theta behaves under various economic conditions, providing traders with insights to anticipate changes in option pricing. For instance, during periods of high volatility, options premiums increase, which can mask the effects of theta decay. However, savvy traders can decipher opportunities by analyzing the disproportionate impact of theta on different strike prices and expiration dates. Incorporating theta into complex strategies requires a balance between long and short positions across different expiration periods. Strategies like diagonal spreads exploit theta decay and volatility skew by combining long-term purchases with short-term sales. Butterfly spreads showcase another level of theta mastery, where traders position themselves to profit from the passage of time while minimizing exposure to directional market moves. The key lies in adjusting the spread components to manage the effects of accelerating theta decay as expiration approaches. Market downturns present unique challenges and opportunities for theta-centric strategies. Options traders can utilize theta decay to hedge against downward movements by strategically selling out-of-the-money puts, capitalizing on the increased premium decay due to heightened market fear. However, this approach demands meticulous risk management. The potential for rapid market declines requires a well-prepared exit strategy and the use of stop-loss orders to protect against unforeseen losses. Advanced trading platforms and analytical software have become indispensable for managing theta effectively. Real-time analytics allow traders to monitor theta's impact on their portfolio, making adjustments as market conditions evolve. Algorithmic trading strategies can also automate the process of adjusting positions based on predefined criteria related to theta decay, helping traders stay ahead in fast-moving markets. Theta mastery is not a destination, but a journey of continuous learning. Engaging with trading communities, staying abreast of financial research, and analyzing past trades are pivotal in refining your approach to theta management. Simulation tools that model the impact of theta under different scenarios can provide invaluable experience without the risk of real capital. These simulations help in developing intuition for how theta behaves in complex market situations. Theta mastery offers a strategic edge in options trading, turning time into a powerful ally. By understanding its nuances and applying these insights with precision, traders can navigate the ebb and flow of markets with confidence. Thank you for embarking on this comprehensive journey through the world of theta with us. May your trades be profitable and your strategies resilient against the test of time. For more advanced trading insights, ensure you're subscribed to our channel. As we close today's journey through the landscape of financial wisdom, we extend our heartfelt thanks to you, our dedicated viewers, for joining us. Please like and subscribe so that we may continue to bring you the best financial education.